Hi friends, welcome back to Simplify India, your ultimate learning partner. Today we are going to learn the various exemptions on capital gains for the purpose of taxation. Before proceeding further, since this video is the part 6 of a series on capital gains and its taxation, so we recommend you people to watch part 1, part 2, part 3, part 4 and part 5 of the series for the better understanding of the concept. First, we are going to learn what is exemption in capital gains mean. A capital gain exemption is an exclusion from the rules that normally apply to realization of capital gains for tax purpose. Under normal circumstances, when a taxpayer realizes a capital gain, it is taxable as income and it must be reported on tax documentation. Now, we are going to learn the various exemptions in brief. That is, under section 54, 54B, 54D, 54AC, 54F and 54G. First we are going to learn the exemption under section 54, that is sale and purchase of residential house. Any long-term residential house held by an assessee is sold and the capital gains arising out of it can be claimed as exemption if the capital gain amount is been reinvested in purchase of new residential house either 1 year before the date of sale or within 2 years from the date of sale, or construct a new house within 3 years from the date of sale, or deposit the capital gains amount in the capital gain deposit account in the bank, provided the new house is been held by an assessee for the period of 3 years. If not, the exemption will be withdrawn. We have exemption under section 54B, that is sale and purchase of agricultural land. Any agricultural land, either short term or the long term, is held by an assessee is sold and the capital gains arising out of it can be claimed as an exemption if the capital gain amount is been reinvested in purchase of new agricultural land either 1 year before the date of sale or within 2 years from the date of sale. Next, deposited the capital gains into capital gain deposit account in the bank, provided that the new agricultural land is held by the assessee for a minimum of 3 years. If not, the exemption will be withdrawn. Next, we have exemption under 54D, that is compulsory acquisition of industrial undertaking by the government. When an assessee as an industrial undertaking holds any of the land and building or machinery which has been compulsorily acquired by the government, which is used for industrial purpose for at least 2 years, then the capital gains arising out of it can be claimed as an exemption if the gain is been reinvested in the purchase of new land and building for the purpose of industrial undertaking within 2 years from the date of acquisition, or deposit the capital gain into capital gains deposit account in the bank, provided that the new industrial undertaking is been held by an assessee for the minimum of 3 years. Next, we have exemption under section 54EC, that is purchase of government bonds. Any long-term capital asset held by an assessee is sold and the capital gains arising out of it is been exempted if the gain is been reinvested in purchase of bonds such as NHA, that is National Highway Authority. Next, Rural Electrification Corporation Limited banks or Indian Railways Finance Corporation bonds, or deposited into the capital gains deposit account, provided that these bonds are held by an assessee for the minimum of 3 years. If not, the exemption is been withdrawn. Next, we have an exemption under section 54F, that is sale of any capital asset other than residential house but purchase of residential house. Any long-term capital asset held by an assessee is been sold and the capital gains arising out of such gains can be claimed as an exemption if the capital gain amount is been reinvested in the purchase of new house either 1 year before the date of sale or within 2 years from the date of sale or construction of a house within 3 years from the date of sale or deposited into capital gains deposit account. Next, we have exemption under section 54G, that is shifting of industrial undertaking from urban area to rural area. When an industrial undertaking is situated in urban area is been sold and the capital gains arising out of it can be exempted from tax if the amount has been reinvested in establishing a new industrial undertaking in the rural area either 1 year before or within 3 years from the date of sale or deposit the money in capital gains deposit scheme provided that the new industrial undertaking is held by an assessee for the period of 3 months. If not, the exemption is been withdrawn. If the amount reinvested in the purchase of a new house is less than the capital gain, then the proportionate exemption has to be given by using the formula. The formula is capital gains into cost of a new house divided by net sales consideration minus selling expenses. Since this video is a part of a series on capital gains and its taxation, so friends, please be stay tuned to our upcoming videos where you're going to learn the computation of capital gains in income tax with the problems based on exemptions. So friends, if you like our video and finds it informative, then please do share it with your friends, family and colleagues, and please do let us know the topics in the comment section on which you want us to come up in our further videos. Thanks for watching Simplify India. Please do support us by subscribing our channel. Simplify India.